Hello and welcome to Trading Hour on CNBC TV 18. I'm Ekta Batra and with me Surbhi Upadhyay. Well, we have started off the January series. It's not yet January, but we've started off the series on definitely a positive note. So up around 98 odd points for the Nifty, up over 300 odd points for the Sensex. Cannot complain about the advanced decline ratio. Let's see whether it manages to sustain through the trading session. But currently looking good on the screen at around 1,300 stocks advancing to around 500 stocks which are declining on the Bombay Stock Exchange. A lot of stocks to discuss, not as many as we would like. Maybe a couple of the Tata Group stocks are buzzing around. United Bank of India, which is higher, Lemon Tree, which is in focus. So we will be covering those stocks through the next 1 hour. But overall, turning out to be a steady session. We had the global tailwind, which aided us. Crude prices still on our side. Hi, Surbhi.
Hi, Ekta. Well, when you have India bowling out Australia for a paltry some 150 odd, and then generally there's a feel-good factor in the air with the market rising, and it's Lata's birthday. I think it's a culmination of all these factors.
I think it's low volumes also. So, you know, majority of the people who could be making negative decisions are on
They're
holiday.
already out. They're like, save it for another day, another year perhaps. But yes, as Ekta pointed out, can't complain because it's a very widespread rally. You've got participation from all pockets of the market. There are barely some 4-5 stocks on the Nifty which are negative, and it's been very steady. Till now, no volatility and lots of interesting mid-cap action as well. In fact, we'll be covering some of that. Real estate is a theme. There could be some more relaxation on the CRZ regulations in Mumbai. We are expecting details in a cabinet briefing. So more on that also coming up. However, let's get first of all started with the market conversation itself and see what trades you can look at in the last few days of 2018. Mitesh Thacker of miteshthacker.com is with us. Mitesh, now, so far, so good. It's bulls in absolute control. And you know what? We're positive for the month now. We're up 3% for the year. Is there a long trade still if someone hasn't yet gone long in the morning?
Good afternoon, Surbhi. I think, yes, getting past this 10,825, 850 zone does suggest that we could possibly see extension of this up move to 10,950, 70 zones, and beyond that 11,080 could be tested. So we have two upside targets, and the short-term setup is on the positive side. I think a good entry point would be another 10-15 points lower, or maybe you could start buying right now and add a bit more if it were to drop by, the Nifty was to drop by another 15-20 points. Keep a stop at 10,820. Try to accumulate around this 10,860, 870 zones and look for 10,950, 70 as your first target, and then we can take it from there.
Recommending?
Yeah, I have two stocks on the long side. Sun TV, after a long time from an extremely oversold levels, is trying to reverse. Buy with a stop at 589 for targets of 620, and Cipla is in a similar position. In fact, the pharma pack is enjoying some momentum. So Cipla is a buy with a very tight stop at 515 for targets of 534.
Okay. Mitesh, I have one mid-cap stock for you in case you could just look up the chart on this one. Lemon Tree Hotels. Interesting journey. It's been fairly volatile in the last 12 months. There's fresh news. They're doing a lot, this company. I mean, they're adding new keys in Pune. Today we had them talk about, you know, sort of accommodation for workers, for students. Stock suddenly quite excited.
I think a very good positive news. See, if you look at the stock chart on a weekly basis, the stock has been doing, ever since listing, has been doing a range of about 85 to about 65. It's hit the lower end, started to move on the upside. I think 85 should be retested again. Possibly this time it could be crossed, which should give you targets close to about 100 on the upside. So I would be a buyer here. Accumulate the stock right now and on mild declines. Keep your stop loss just below about levels of 70. So then you have about 5-point risk. 85 should be your first target. 100 should be your possibly second target. And all this could happen in the next 5 to 6 weeks.
Okay, all right, Mitesh, we're going to let you go on that note. Thanks very much for joining in and taking us through all of those calls. But now let's cut across to Lata Venkatesh, who's in conversation with Sanjeev Sanyal, Principal Economic Advisor to the Finance Ministry.
Well, a new year is always a great time for stock taking. There are new hopes for the Indian economy in terms of probably lower crude prices, a nascent private capex cycle ticking up, and perhaps cheaper cost of capital. On the other hand, there are new challenges, especially from the global scenario where liquidity could be tightening, where perhaps trade wars could still make space a little difficult for us, probably slower growth for the global economy as well, and especially for the two big economies, the US and the Chinese economies. How do all this tie up in terms of prospects for the Indian economy? We're going to ask someone who is best placed to answer that. Sanjeev Sanyal, economist, environmentalist, author, urban realist, and of course, principal advisor to the Finance Ministry. Sanjeev, thank you very much indeed for joining us. Well, actually, let us start with the global, because every day we are getting bombarded with either tweets or an extremely volatile Wall Street indices. How are you looking at the 2019? Are we going to see this balance sheet crunching by global central banks beginning to make the cost of money expensive? Is it a difficult 2019 for us as far as the world is concerned?
Let me begin by wishing everyone a very prosperous and happy 2019. And a very happy birthday to you, Lata, as well.
Thank you. Thank you, Sanjeev.
So the world, as we look forward into it, yes, certainly there are a lot of uncertainties. But on the other hand, some things have also flowed our way. For example, oil prices have come off a long way from when they peaked in October, November. If you remember, they were at 85. Now we are looking at 53. So much better. Yes, there are some apprehensions about the world economy slowing down. But on the other hand, remember, the US Fed has suggested that it will probably tighten somewhat at a pace that's somewhat less steep than had otherwise been, which, by the way, is very good for us, because it means that the global liquidity conditions of anything will be somewhat easier than we had earlier anticipated.
Okay.
There may still be some tightening, but much easier than people had anticipated earlier.
Okay.
Yes, of course, trade wars make things uncertain. But again, as I said, not entirely gloomy. I mean, there are areas where if we in India, look at it positively and try and find ways in which India can, insert itself into a new global supply chain that may be emerging out of these trade wars, then in fact we can take advantage of it. So I would argue that yes, there are some challenges, but there are many areas where in fact India can take advantage of the situation, from lower energy prices, somewhat easier global interest rates, and perhaps a liquefied global supply chain where we can insert ourselves. So, and many other things as well. So I think not really such a gloomy picture of the world as maybe somebody else would have told you.
All right. No, actually, I want to connect this to the book, that your forthcoming book, India in the Age of Ideas, where you are, I think, trying to define a new role for India, understanding India's history in a new context. But I'll come to that in just a bit. Let's first explore the economy themes of 2019 and then come to how we should relook ourselves in a new global order. The Indian economy itself, the most immediate news that we are getting is that the fiscal deficit is now 114% of the full year budget. It normally tends to be higher in the months of November, December, and gets corrected as advance taxes come in the last quarter. But nevertheless, it's a slightly higher number than we are used to as early as November. Plus, we hear that the government is planning some kind of a farm support, maybe a basic income, maybe a waiver, maybe some way of supporting farm prices. It does look like fiscal deficit is going to get much bigger than we thought.
Let me just clarify that we continue to remain very much committed to fiscal consolidation. So we are not, contemplating moving away from that commitment.
Okay.
As far as the farm sector is concerned, I think we need to be clear that, you see, what is the issue that the farm sector is facing? In the past, the problem used to be for drought or floods or whatever, weather-related factors, we used to be a shortage country. Now what has happened, ironically because of our own success, in fact, in increasing farm production, we have ended up in a situation where we are producing a lot more food than we could possibly consume. So this whole 1960s Green Revolution approach to agriculture that we used to have is basically run its course. We now produce way more food than we could consume or store, and so we need to relook at that. Now, how do we transition away from this let's grow more calories approach to agriculture? Okay. Now, first thing, short term, we need to make sure that the fact that there is this excess is leading to food prices being under continuous pressure downwards.
That's right.
We need to deal with that. There are a few things that we need to take into account. One is we need to make sure that these food prices are held up in some ways, and MSP is one way of doing it. But also remember that the farmers are also facing very high cost of capital. So their output, which is food and other agricultural products, that inflation for that is essentially at zero right now. And they are all borrowing at more than 10%.
Yeah.
So the real interest rate for them is over 1,000 basis points. So we need to begin seriously about reducing the cost of capital. In fact, in some ways, this is the source, if you think about it, for the demands you see for farm waiver and other farm loan waiver, etc. This is the source of it. The cost of capital is very expensive. By the way, not just for farmers, for small businesses and many others as well.
Yes.
So this is one big area. The second big thing that we need to think about is to change the overall framework of subsidies, incentives, etc., which is essentially been about growing ever more food grains, particularly rice and wheat. So we need to begin to rethink this entire gamut of incentives and begin to think about various other options. First of all, we need to begin to think about other crops. We need to think about exports. We need to think much more seriously about cold chains, all of which, incidentally, are in the already being thought through. Some of these policies, like agricultural exports policy, was just recently announced. Huge sort of effort is being put into cold chain and so on. And of course, we need to think about rural economy as something being beyond just agriculture. In fact, there was a recent NABARD study which suggests that 50% of rural incomes is already non-farm. So we need to take a much more comprehensive view of what do we mean by rural incomes than just farming.
Yes.
So the point is we need to take a wider view of the whole matter.
Okay, so agrarian reform more than an agrarian revolution or a green revolution is what you're talking about. But important for me is that you reiterate that fiscal deficit, in spite of whatever farm supports we give, will not get disturbed. The government is still looking at 3.3%?
We are committed to that 3.3%. Of course, there may be some variation around it, but you know, the variations that we will be very minor. I mean, this is not the days where we used to debate 5 and 6% of GDP.
No, certainly not. Certainly nowhere near that. But let me come to the cost of capital itself. Like you said, we have got a severe food disinflation, which has actually been surprising. One thought that MSPs would perhaps increase the prices. That has not happened. And now to add to that, we also have a fuel disinflation. So what do you look at in terms of how much rate cuts can come? We already have a fairly comfortable liquidity with the Reserve Bank promising 50,000 crore of bond purchases December, Jan, Feb and March. To add to that, how much space for rate cuts do you see in 2019?
Firstly, let me clarify that this is really the prerogative of the Monetary Policy Committee. So I can't comment on exactly how much they should cut. But I can lay out the landscape.
Okay.
Basically, inflation is now running at the bottom of the range that the Monetary Policy Committee had been given. And we have now, it's just not something new, we have now had for some time inflation running at or below the midpoint of that range.
Opposite.
So inflation, I think, has structurally come off. I think it's fair to say that the old 7 or 8 to 10% range of inflation that we used to have, that has been lowered by some good, 500-600 basis points. So if that is the case, we need to see a commensurate reduction in the nominal interest rates. Otherwise, you have real interest rates running about the highest in the world. I mean, small business still borrows at 12 percentage points, right? Now, if inflation is running at 2%, that's 1,000 basis point
real interest rate.
Clearly, 1,000 basis point, at least an 800 basis point real interest rate for large parts of the economy. This is clearly not tenable because of a variety of reasons. First of all, this is a source of enormous financial stress to the balance sheets. So this is a major problem for small business, large business, for farmers. After all, farmers can also be seen as small business, and so on. It also causes stress on our fiscal side because the government is, after all, the biggest borrower from the system. So it is a stress on the fiscal side. But also, ironically, keeping high interest rates over long periods of time also increases inflation. This is something that economists tend to forget. That while high interest rates in the medium term lowers inflation, in the long run, high interest rates mean that you do not build capacities that you would have otherwise built, whether infrastructure, in industry and so on. So you end up with higher supply side inflation in the long run if you keep interest rates high indefinitely, irrespective of where inflation is. So I think we have structurally brought down inflation. We now need to take step 2 and structurally bring down the interest rates so that they are in sync with the new level of inflation. And that, when I say, when we have to think in hundreds of basis points. Now, exactly what trajectory the MPC takes, of course, is their prerogative.
No, a fair point. It's just that I would assume that the MPC would be convinced of the food disinflation that they have seen and the fuel disinflation, especially if crude continues around this $55 mark all the way up to February when the MPC meets next. But more importantly, they will worry if fiscal deficit is higher than they thought. For instance, we have seen a spate of farm loan waivers coming in from the state governments. In addition, if a big package comes from the centre, that would be a spot of bother for MPC, won't it?
So I would argue that you cannot see these things in isolation. I mean, one of the points I make in my new book is that you have to think about the system in a holistic way because everything is connected. If you keep real interest rates at these high levels for the farmers, naturally there will be pressure to do farm loan waivers and other things. So you make cost of capital exceptionally high, then it feeds through, the imbalance shows through somewhere in the system. So the point is, once you have lowered food prices and inflation generally, you have to allow the rest of the system to adjust. Otherwise, the political pressure or other economic pressures will show up somewhere. So these are...
Okay, an extremely comprehensive conversation taking place with Sanjeev Sanyal there, and we'll keep getting you more flashes from that conversation as well. But talking about the fact that lower interest rates would probably be something that the economy needs to work with now, considering the kind of seminal fall that we've seen in food prices as well, and with the argument that, eventually higher interest rates also results in higher inflation.
I think he's making some very, very interesting points and a very strong pitch for the Reserve Bank to lower rates, because he's gone on with simple mathematics to say that with inflation coming down to 2%, real interest rates for borrowers, for farming borrowers, are as high as 10%. And that is not sustainable cost of capital for either farmers or for small businesses. And then, therefore, all this talk of farm distress and the need for perhaps waivers. So I think, there's a sort of lot to be read between the lines as well here.
Yes, and interest rates is one important thing, but that's obviously not under his direct control.
Yes.
I mean, that's not under his decision making. But what he said probably on fiscal deficit would also be more relevant, considering the numbers that came out yesterday or last evening, where they did say that, the fiscal deficit target for FY19, which is 3.3%, will be something that they will look to meet. There could be minor variations. But
minor variations being the quote-unquote word.
But you're not going to go back to those historical levels of, missing fiscal deficit or concerns of a huge miss in terms of...
So staying on course, the trajectory is intact. At least that's what he's promising.
I think that would be important, because that's a key concern that a lot of economists have today, that, fiscal deficit will probably not be met for FY19. The target is 3.3%. The street is anywhere between 3.4 to 3.5%.